Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we have our econ show. It's going to be a little bit shorter, which I'm sure everybody's happy about. We're going to look real quick in terms of globalization and how that has shifted and what is really going to drive things going forward. As we've said before, we thought globalization was going to adjust. It wasn't going to go away, but it's going to change in the way it looks. Then we want to look at inflation, how it accelerated again, as we've been saying it would. And we want to look at some of the key pieces because PPI, bounced again the most since the most since June. So again, the PPI, if you remember, is a leading indicator for some of these CPI numbers, which, as we've said, continue to be concerning. Then we're going to talk about retail sales. They had a nice bounce, but will that last? And what really drove that increase? Because when you dig into the numbers, it was good, but what was the big driver? Then we're going to talk about how there's more ECB tightening ahead. And then we want to look at Chinese loan growth and how that continued, how that really increased. But we also want to look at how India's inflation surged once again. And what does that mean for rate hikes and the Indian economy? So now jumping right into the fun of globalization, I thought this was a really good chart from the IMF looking at the eras of globalization and how trade openness slows and adjusts. And as you can see, during when we went into the global financial crisis, you had globalization take a pause. And typically that is just because you have less trade, less flows. And one of the key pieces, which I don't know if this picks up as well as I think it should, just because FDI or foreign direct investment increased, was general trade has been trending down. And again, it's not like it's collapsing by any means. And we had a chart on it last week where you're seeing the general trend since about 2012 continuing to adjust lower. And one of the things that is how this is going to change the way it looks is more from the perspective of nearshoring and onshoring. So when you nearshore, you're bringing it closer to your coast, but not in your country. So does something go from China to Mexico? Does it go from Germany to Mexico? Does it go from France to Brazil? Is there an adjustment? And not to say that that's closer because, based on wherever you're going, it could be further. But what you're just seeing some of these adjustments. And when you look at some of the flows and shifts in general, there's the biggest impact, as we've shown, I think it was a couple months ago, how China is the one that's seeing the most impacts from it as more and more companies look to leave. And it's not just China. It's, when you look at Japan, when you look at South Korea, there's going to be ramifications because there's a lot of crossbreeding between these different entities because you have, a semi-finished product going from China to South Korea, then they're doing something additional. Then that product's going to Japan to getting assembled into its final product onto the end, and vice versa. And the problem is, as companies leave one area, do they leave multiple or do they adjust in different levels? And that's why we said it's not going anywhere. Globalization is still going to be here. It's just going to look different. And that's not a bad thing. And that's something that we've been calling for. And I personally have been talking about since 2016, that we really needed to adjust and change our supply chains because they were getting too narrow. They were the at-time delivery was the newest thing, but there was no variation. It was just us, China. There was very little interaction outside of that. And now you're starting to see that broaden a bit. It started in about 2018, where you saw some additional clothing and sneakers and other types of retail type stuff moving out of China into ASEAN nations, India, Pakistan. And again, those are things that now the kind of the last wave to come is going to be the tech side. It's going to be the some of the broader manufacturing, which is something that China is going to try to slow down because they need that. They need some of those jobs in general. But that's going to change, especially as costs go up based on labor, based on some of these pivots that we've seen on rates, inflation. And that's where we see some of these different adjustments. But as that happens, and this is just taking the US side in terms of the decomposition of this previous CPI component for primary rent, but it's also for other things. When you start looking at rent, rent is a problem in the US, obviously, but it's also a problem elsewhere. And that's why we talk about this, because when you look at the rent side, it's expensive. It's expensive everywhere. And then when you look at the global monetary conditions, nothing here is showing that it's restrictive. And that's a problem when you look at liquidity, when you look at what they're trying to get in front of. And rent is telling you, it's like, look, there's still a long way to go. And there's been some very interesting points when you look at the demographics, how they continue to shift for the worse, especially when you look at China, where you've had the demographic shift. When you look at Japan, when you look at South Korea, when you look at the US, the demographics are moving in the wrong direction. And it's difficult to have a large family or to support a large family when you can't climb the economic ladder, when you can't get a home or some sort of stability on a rental basis or on just a home ownership level where you're building equity for yourself. And unless we bring those asset prices down, it's going to be difficult to adjust some of these demographics. And I think it's interesting, and it's something that we've worked on. And as we come out, we'll show our findings. But inflation also is a driver of the reduced demographics, because as inflation goes up, we've seen what it does to stagnating wages, to declining real wages. And as it gets more expensive to have a family, well, you just either don't have a family or you have a smaller family. So if you think about a woman needing the average woman needs to have 2.3 children to keep things grow in a growing standard, 2.1 just to keep things flat. If we want to really pivot this, well, what's it cost to have, and you can't have obviously half a child. So what does it cost to have three children? What is the realistic cost of having a third child? What is the cost of having two children? And when you look at the exponential growth across everything from healthcare to childcare to food to home, furniture, all of these things, it adds up so quickly that it becomes very prohibitive to have that child, which is why as inflation goes up, as asset prices go up, as other things go up, and a lot of these services remain sticky, that becomes a problem. So there's a very clear, in our opinion, correlation and connection to inflation, obviously wages, and then what does that mean for the demographics? And as those deteriorate, it actually creates more economic pressure. So that's where the inflation story gets very interesting. And that's why, when we look at it in general, there's going to be need more policy changes, more policy rates to really try to get in front of the housing side, the asset side, because that is also going to drive some of those demographics. And obviously, food is going to be a very pivotal piece. Now, we're going to do a special show just on food because there's so much great data, treasure trove that's come out that we want to provide a clean update for where things are really going. But global food prices continue to decline year on year, change down to minus 3.3%, which is the slowest since May 2020. But it puts into perspective just how elevated it still is after a decline going back to 2000. And now, a lot of the new data has come out, which is, the wheat side in India has gotten a bit better. The soybeans, corn, and wheat side in Brazil and Argentina has gotten worse. And a lot of this is just based on, again, weather. There's been La Nina has impacted the Latin American continent. It's creating very dry, very hot weather, which is impeding a lot of these growing components, especially when you look at planting and emerging. And the US still remains under the same guise of La Nina. There's a lot of area that's in drought, and you're starting to see the estimates getting taken down for global availability of food. And this is going to have to be one that is addressed as well, because when you look at who spends what on food, emerging markets spend a significant amount, but the US consumer is spending more and more. And as that layers in, and for those who are clients, you're going to get a fairly deep dive on food in your inbox on Friday. And it's going to be a very important piece to how do we address some of these different adjustments, and how do we try to bring that food price down. But when you look at the comments on soft landing, it's funny because When you think about soft landing talk was happened in 2000, it happened aggressively in '06 and '07, and it's happening now. And it's always going to be a soft landing. It's never going to be a hard landing until it is. And again, it's not one of the things that we've talked about is we're not going to get this massive implosion. Like we're that's not the world that we sit in right now. It's going to be a death by a thousand cuts. And instead of getting this big kind of washout, it's going to be this minus zero point 0.5, minus 1% growth rate, which is going to be prohibitive. It's going to be something that we've seen in previous years. And there could be a point where you get a deep drop. But again, there's going to be a lot behind that. But in the meantime, when you look at the trucking data in the US, when you look at the flows coming around the world, there is a clear reduction of global trade, which again leads to what we've been talking about of a more broader slowdown. But things are changing. And this is something that we've talked about in the EIA show. In the US, people are not going to the office the same way, about 40% below normal. But it's not just the US that is doing that. And that's why when we talk about globalization, it's changing. Is there a way that, for this podcast that you're watching, or this YouTube that the podcast you're listening to, YouTube that you're watching, we have people helping us around the world. We don't have to have people located in the US. We have people in the US across different time zones. We have people across different continents. And that's something where as you work from home, or as you go to the office less or need to be in the office less, you get a bit more of a decentralization, but not in the physical sense, which can help bring down costs in different ways. So I think it's a very interesting time to see some of these moves, especially because when you look at the price dynamics of of main materials, core base metals, they're heading higher. So if you think about, and the reason why we bring this up is because if you think about moving an asset from one location to another, you have to build it. But what is the cost to build it? What is the cost to run power to it? What is the cost to bring some of these in? And because of the disconnect between supply and demand, where supply is pretty, let's just say capped, and demand is fairly stable, if not rising a bit, especially on the copper and nickel front. When you look at EVs and green technologies, that's going to keep prices elevated, and it's going to increase costs for a lot of other things, especially if we start to build new facilities, because those facilities need copper for wiring. They need nickel for strengthening of the steel, or nickel in terms of if they're creating batteries or some other manufacturing process. Then you need the wire line to bring the power or the electricity from a local entity or a new power station to that entity. And then that power station is going to need copper. So again, there's a lot of this that continues to feed in on itself. So as you get this nearshoring, onshoring, that's going to be inflationary. And as that inflation drives up, or creates that tailwind to inflation, well, then you look at rent, and rent has been elevated. Then you look at that inflation component. And that's where, when you look at global rates and global central bank activity, it's going to be difficult to see this much bigger pivot. Emerging market debt and equity inflows are rolling over, which is something that we expect to happen. And as that happens, when you look at some of the financial corporate profits, as you look at some of these different shifts in CNI, and just, essentially just building, that's where we see some of these profits coming down. And again, that's going to put that headwind into global growth, and why we see some of that movement lower. And then when you look at the US budget, the US budget is moving in the wrong direction, in terms of Medicare, Medicaid, Social Security, non-defense, defense, but the net interest expense is going up. Right now it's 442 billion. It's likely going to cross well over 500 billion quickly, given the fact that not only do we have to pay current interest, but we have to borrow another $1 trillion every year at this point, unless we have some form of austerity. And that's going to add up. That's going to create a bigger problem, and it's going to make it difficult for the U.S. to pay its bills. It's going to make it difficult for things to continue to see this form of stimulus, because let's be fair, by the fact that we're borrowing, that excess is stimulus, because we're going into the market, borrowing to try to stimulate the economy in some way. And we're going to have to balance those books. And that's going to become a very important piece. And then I had a podcast with Gary Brody again, And he brought up a great point. He's like, this is just what we know on the books. But what about the off balance sheet risk? And that's where you see this massive number that's measured in 250 some odd trillion that isn't talked about, that we have to address. And that's why is we have to start somewhere before we start to get into the more esoteric. And that's why it's going to be important. But if the US, being the largest buyer in the world, the largest economy in the world, is pulling back, well, what's that going to do to the global market? Is there somebody in the wings that's going to drive some of that growth? And we've talked about multiple times how we don't see China as filling that void, given the issues on the real estate side, the losses that have been taken, and the fact that savings doesn't even come close to covering it. So that's what we have for you on that cycle. And then let me wrap that up as well, because they're also the beneficiary of globalization. And as things shift, they're going to be the biggest ones hurt by the shift. So again, you see some of these pivots and these problems, which really, I think, what we think is going to create that stagflation and that headwind on growth. So that's what we have for you here. On the next segment, we're going to go deeper into the US and some of the shifts that have happened on some of the recent data that has come out.